10 years ago, someone else looked at the health of the British economy through the human capital lens. I don't know how many of you do remember. I'm sure practically everyone will. Denise now, Lady Kingsmill. Do you remember the Accounting for People report said, and I quote, "This is the moment when HCM takes its place in the boardroom. Directors need to transform the airy cliché about people being their greatest assets into a guiding principle of business strategy." Well, I think as we all know, it hasn't yet taken its place in the boardroom. And in part, and probably in large part, at least that's what I'm going to argue, this is probably due to the fact that investors today still don't understand HCM well enough. When you talk to Wall Street and the City about HCM, and I've been doing this for nearly 15 years, what you find, and I'm going to go back into my medical persona here, is 5 categories of patients. First, we have the happy imbeciles. They're an honest group. They kind of say, what's HCM? Isn't that what the HR department does? Then you have the supportive pessimists. Well, you know, yes, it's important, but it's a soft factor. Management can game the results. The reporting isn't very transparent. It's not peer group standardized. So just for the moment, we're not going to be dealing with it explicitly. Then we have a new group, the sustainability smooth talkers. Yes, of course, this is very important. And, you know, we have a niche process and a niche team that really specialize in this area. And just to show you how important it is, here's our report on the subject. We also have the out-and-out denialists. Of course, we take into account any investor worth their salt is interested in the quality of management. Finally, we have another honest but rather misguided group, the market fundamentalists. If it's important, it's already in the price, what's the problem? Of course, some of these points actually do have some validity. I was being a bit flippant about them. But taken together, they actually account for why the system is stuck. And it amounts, in my opinion, to an abdication of fiduciary duty on the part of investors not to take such an important intangible. And I know Philip is going to challenge me on the word intangible, but you know what I mean. To not take this into account. So, there's the diagnosis. What about the prognosis? You know, some of the strongest memories that I have from my medical days is of caring for cancer patients who really struggled to get themselves into remission, and also on the other side of looking after alcohol addicts who kind of just kept going, drying themselves out, starting again, falling and getting up and going. And what they kind of taught me in their different ways was that actually hope in human agency, hope in the possibility of change is really critical, whatever you're doing, whatever your condition, wherever you are. And I think we have to have that hope because we have a system at the moment which is addicted to growth, aka cancerous, and it's creating dysfunctional patterns of behavior which harm the individuals, but also which externalize that harm onto future generations, onto the poor, onto the environment. And so it's really a serious condition, but yet I think it's right to be hopeful, because I think when we're hopeful, we can see things that we might otherwise miss if we weren't. And so with those kind of lenses of hopefulness on, and I hope you realize I'm not saying optimistic. With those lenses of hopeful on, I think we see 4 things that offer a better prognosis. The first is innovative academic studies. Then we have pilot investor activity, a new focus on long-term investing, and a renewed attention to reporting. I'm going to give it to you straight, as I hope you want your doctor to do. I'm going to tell you the good and the bad, and some of the ugly as well. Academics, will they come to the rescue? Well, over the last 10 years, I've seen some great academic reports looking at the link between human capital management and corporate performance, even human capital management and investment performance. And we know the investment system consists of very bright individuals who are trying to outperform each other. They're looking for new sources of data. So what's not to like? Academics must be part of the solution, right? Sadly, in the 15 years that I've been looking at it, it doesn't work. There are reasons, and you'll see why if you have a look at the article in your USB stick, that academic contrarian results on a bottom-up basis doesn't change the system. I'm not saying that's of no value, but I don't expect it to be a paradigm changer. So, are enlightened investors going to come to the rescue? Well, there's some good news. And the good news is that the responsible investment community, the community of investors who are looking to environmental, social, and governance issues, are part of the solution. The bad news is that they don't amount to very much at the moment. You know, there is interest on the buy side amongst the asset owners and fund managers. I was working at AXA Investment Managers. We started a fund that still continues. It focuses on human capital management. Schroders, a very large fund manager, is also interested in it. We have positive statements from the local authority pension fund forum. CalPERS, the giant pension fund in the States, has made important positive noises about it. But these are pilots, niche projects, policy statements, not policy statements, they're think pieces. They're not coming from the chief investment officer as part of their day job. Perhaps the biggest problem is the information intermediaries, and I'll come back to them, the sell-side research and the credit rating agencies. They're really pretty blind on these issues. The credit rating agencies, even worse than the sell-side. There is some interesting work from the sell-side happening. So the verdict on the responsible investment community is hopeful, but not yet, just yet. Part of that is because there's another area of possibility, both hope and also some bad news, and that comes with the long-term investment movement. As many of you know, there's been a furore about the short-termism of the investment community, and this has led to action by governments in many places. I'm going to Paris next week for a meeting, a private meeting convened by the OECD, who want to try to develop a set of guidelines or codes for long-term investors. And in the UK, what we had was the K review. In my judgment, that's had a profound impact on the intellectual discourse around this debate, because before the review, intelligent people inside the system could get away with saying the long term was just a series of short-term steps. And I don't hear that anymore, thankfully. Very importantly, John Kay explained how the stock market is no longer the primary source of new capital, but it's fast becoming no more than a secondary trading market where existing shares are just traded by back and forth in milliseconds by adrenaline and testosterone fueled traders. Actually, perhaps even worse than those are the very clever computers that are located right next door to the stock exchanges, each trying to outguess each other. And he also shone light on the fact that we have a very overly mediated system. Thanks to Michael and James, we have a wonderful little diagram of this. And the important thing to note here is that the key players, the information intermediaries, as I call them, the sell-side analysts and investment consultants, tend not to figure in discussions, but they are the power brokers. They are the gatekeepers. So we don't really have an investment system that inspires confidence and trust. And when you look at the K review, it's rather light on hard recommendations. Paul Miners, Lord Miners, who did 5 related reviews for the government, both governments, thinks that John and Vince Cable were, and I quote, worn down by the weight of institutional lobbying. I can't tell, but what I can tell you is that most of the insiders within the system that I know don't expect the K review to change things that much. So let's get back to the positive. Ooh, voluntary reporting. Can we make it work this time? The good news is that in the past, there was the OFR, the Operating and Financial Review, and narrative reporting. This time round, there's a lot more activity. I don't have time to go into it, but it's international. It's involving the market, which is the most backward in this area, the North American market, and it's involving the auditors and the main investors. So in many ways, it's a much more positive development. The big question, though, is can these voluntary reporting projects deliver? And the honest answer is, I don't know. There's a very interesting example just from last year from the States, which some of you will know about. a well-thought-out voluntary reporting initiative initiated by human capital HR specialists at the Society for Human Resource Management. And who shot it down? Fellow human resource practitioners at the Human Resources Professional Association. When I read the kind of reports of it, it almost looks sort of Catholic, Protestant, Shia, Sunni in its intensity of the conflict. So to summarize on the prognosis, I'm not a happy, clappy optimist, but neither have I given up hope. And the reason I haven't given up hope is because people like you are listening, are thinking, are willing to change what you do. And whilst that's happening, then I think we're very similar to the patient who can get through cancer and the alcoholic who can become a recovering alcoholic. But that's not going to happen easily. We really need to do something if we're not going to come back. I would hate to be back in 10 years' time, Michael, having the same conversation about why we haven't moved anywhere. And I think if we're going to avoid that dystopian future, we really need to go for the treatment plan. And you know, with my medical hat on, I'd like to offer five treatments, actually. Some are more at the emergency resuscitation end, and some are more at the prevention end. And I'll go through them one by one. The first is that we have to bite the bullet on minimum mandatory reporting standards. HCM advocates have long said that regulation isn't the answer, that voluntary reporting is the best way to get compliance. It seems to me, and you know, I was just reading in 2012, the CEO of the Chartered Institute of Personnel and Development was still arguing for a collaborative effort between government, accounting bodies, professional institutions for HR and finance. I wondered, where was he during the OFR process, during the Kingsmill process, during the follow-up to the Kingsmill process with David MacLeod and engaging for success? I think it's pretty unrealistic to expect the same thing to do something different just because we have that expectation. It hasn't been cracked so far with voluntary efforts, and I think we just have to understand that the sky doesn't fall down when you have mandatory reporting. It happens in France. They get on perfectly well with productivity and managing their human capital. We can do it. It's not a perfect solution. You know, people can go further, but resuscitating a patient who's just had a heart attack isn't a perfect solution either. It's just the first step. Second, we need to make information intermediaries focus on material HCM performance. Once a patient is stabilized, you often transfer him or her to ITU, where you can do some intensive treatment, dissolve the clots. Similarly, for the investment system, if you remember back to that slide, there are some clots that need to be dissolved, and those are the information intermediaries. We need to make sure they're much less HCM blind than they are today. And I think the groups that we can best focus on are the investment consultants, because within their organizations, they say they have sources of expertise on human capital. So really, we just need to get them to join up the silos, so that they can offer investment advice, which is HCM savvy. Third, we can use HCM to give the K review some teeth. After a coronary, when the patient looks on the road to recovery, it's not uncommon to have serious arrhythmias. And if that, you know, your heart ceases to beat in the appropriate way, and at that time, you really need to react assertively. Strong drugs, maybe even shock the patient. Well, today, the analogous situation, I think, is that investors are stuck with a trading system which risks flash crashes. We have our risks of coronaries ourselves as investors. And it's got to the serious point of people like Robert Soloff, a really mainstream academic, raising the possibility that actually we have all this trading activity for almost no value. Destroying value is in effect what happens. Not, of course, to the people in the trading system. This is a hugely complex area, and it's not the subject for today, but one area which I do think is politically ripe for action is to deal, and it's an area which has a strong HCM link, is to deal with what John Kay called the reckless M&A activity. Some of you might consider it a bit ironic that Lady Kingsmill now thinks that regulators should consider the public interest more actively than they did when she was the vice chairman of the Competition Commission and in charge of looking at mergers and acquisitions. The only answer I have to that is what Keynes said: when the facts change, I change my mind. What do you do, sir? Fourth, we need to create the conditions that encourage more long-termism. Sometimes a patient after a heart attack does something a bit silly. You know, will sneak out of the ward to have a little cigarette outside. That point is when you have most ability to engage that patient's sense about prevention. And prevention is as good for companies and the market as it is for human individuals. We have to be realistic, though, however. You know, most investors today do not have an incentive to worry about human capital and the long-termism. That's about 2/3 of investors don't have that incentive. Half of them are mechanical. They're the algorithm-based trading index funds and the very clever quant models. They're HCM blind. The other half are maybe interested in HCM, but only from a short-term arbitrage perspective, a sort of scuttlebutt perspective. Only 1/3 of investors are interested potentially in this area, the fundamental investors. And it's not possible to expect those people to cure the market, not least, for example, because most of those investors aren't exposed to the whole range of SMEs. So we have to expect other players to act, and the government is a key player. It needs to make sure that investors push appropriate long-term remuneration policies through the system. It needs to make sure that auditors are really independent. There are a range of things that are needed to create that kind of ecosystem of conditions which allow long-termism to flourish and be rewarded. Fifth, we need to give greater weight to the training needs of UK PLC as a whole. To continue the medical metaphor, one of the best ways to reduce the number of coronaries is to educate children not to smoke. It's very cost-effective and highly efficient. The HCM equivalent, I would say, of this epidemiological approach is to get investors and companies to take the training needs of corporate Britain into account in the company-specific strategies. I think that means a big radical shift in corporate training strategies. And the reason for that, I think, is quite sensible, really. Knowledge is changing so fast that it's not possible to expect people to come in with what you need, however good the public education system is or isn't. So rather than whinge about what the public education system isn't doing, what I would suggest is that corporate leaders should sort out what they need within their companies for themselves. This is a shift because it starts to focus training more on the people at the junior end of the management ladder, not just at the top end. It also means trying to find ways to change operational accounting at the company level so that training is accounted for as an investment, not a cost. Incidentally, this public health approach would also suit the investment community really well because investors meet their liabilities through the beta, the market returns, and therefore there's another reason to take account of the public health of the nation. Michael will be pleased to know I'm coming to my conclusion. I want to switch from a medical analogy to an engineering one. You might have gathered what that's going to be. The investment system today is like a very exquisite and certainly very expensive watch. Beautifully crafted. Internally, there are the finest of resources working in total synchronicity with each other. And the only problem is it doesn't tell the right time. It does tell the right time for the people within the system. They're doing quite well, thank you. But for everyone else, you, me, our friends, the woman on the Clapham omnibus, it's not working. And that's, you know, not disputed. The way HCM has and is still ignored by the system, I think, is a nice bit of evidence, really, of this watch. But I think it's important to understand that we don't just have a reporting problem. we don't just have a metrics problem, we don't just have a remuneration problem, we don't even just have a governance problem. We have all of those problems, and they do need to be fixed. But fundamentally, we have a narrative problem. Actually, we have a meta-narrative problem. Our story that we tell each other, that we communicate through business schools. I was at the London Business School recently, and they had a big event about this. The story that we're telling is badly broken. We need to fix the technical problems, but trying to do it within the current narrative will fail, or at best have incremental slow progress. Charles Handy, one of my favorite business gurus, was recently asked what he thought the purpose of business was. His answer makes a lot of sense to me, so I'm going to quote it. It's not to make money, but it's to do something that's more useful to more people than anyone else. It's kind of Charles snapped up there. And he warns companies who think of their key people as assets that they are, and again I'm going to quote, mistaken. Because assets are things that you work to death. They are talents. People are talents. And talents are a thing you nurture very carefully, like plants. We're in a time of deep flux, and that's why I'm really excited by the HPA project, because I think with the system's profound immunity to change, the only thing that's going to work is for small groups of very empowered, interesting, quirky individuals to come together and actually steer a consensus between the different stakeholders, the companies, the executives, the accountants, the regulators, the unions even, so that we can move forward in this. And this network needs to be kind of, in my eyes, a leadership network of people who are willing to be a little bit more courageous, a little bit more outspoken than others.
Or quirky.
Quirky. Positive deviance, I would say. So that's why I'm here. I'm delighted to start the conversation. I'm looking forward to your questions and challenges and comments, and thank you very much for coming.
Over to me. I have to say, Raj, you did exactly what you said you would. You've covered the ground, you've covered it in the time we gave you. I thought that was a remarkable summary.
Thank you.
I'm going to, in fact, only ask one question, and it's a longish question, if you would let me get through it. And it's on one of your slides. It's the one that said putting some teeth into the Kay report. I know that John Kay is a friend of yours. I know that you admire him enormously, and I know that probably you would give him a B for his work there. And if we wind the clock back, what Kay was asked to do was to investigate whether the equity market was doing what it should be doing to promote the general prosperity of the government in a global market. That was his remit. Let's slip out of these abstract nouns like equity market. Let's just say that we're actually talking about people. Shareholders. What are shareholders doing in that direction? And Kay's answer is they're not doing very much at all. Just as you said now, there's a lot of intermediaries who are trying to do it for them, and you've also made it very clear that those intermediaries are very skillful at buttering their own bread, to put it that way. I thought I'd try and stick with your medical metaphor. I can't really compete when it comes to that, but you would probably say, wouldn't you, that the problem with Kay was that he only made he didn't even give recommendations. He didn't even give a prescription, when in fact he should have sent the whole boiling to A&E to get a more radical solution. It was a bit like going to the doctor, and the doctor says, come back in a fortnight if you're not feeling it, if you're still feeling the same way, and here's a few sugar pills, as it were, to keep you going. And that didn't take us very far. It was as though he then added, oh, by the way, I'd send you to a specialist. That's the government, except he's retired. So in a sense, there was no recourse there for Kay, and I do agree with you that probably there was a gap of 3 months before his provisional report in February, I think it was, and the final report in July. And I think he was stopped in his tracks by the vested interests that he was facing. Another abstract noun is the government. Mm-hmm. The government is people. People is what interests me. I'm a psychologist, trust me. And all he got back from Vince, because we're talking about people, we're talking about BIS, the Business, Innovation and Skills Department of the government. I noticed the other day that Vince Cable was described as the former economist, which I thought was rather telling. He's just a politician now, so not much. And essentially what Vince Cable said was, sorry, Gov, there's nothing I can do about it. The markets will have to look after themselves. That was very helpful. So the government gets a B minus.
You're generous.
Yes, a C probably. Which means that, and I'm looking for breakthrough points, it means that somebody needs to lean on the government. And in fact, it was interesting that the Public Accounts Committee grilled Google just the other day. That seems to me to be a much more potent way of getting at people who are cheating on the exchequer in one way or the other. But as I'm looking for a way to break in, and I think you pointed to two. One of them is that we need to get the government to be more active. One of them is we need, I think you were implying, and you might want to come back to me now with that, the pension funds are a way in, as in a sense the only true owners of shares, or the identifiable true owners. And we could get at the sell-side analysts who are so influential in buy, sell and hold through their algorithmic computer-generated things which tell them nothing about people. It was a long question. Do you have anything to come back to on that?
Yes, and I've been working in this space for 15 years, so I've been trying different levers of change. I do believe that when they mobilize, the pension funds will be a bit like the hobbits. They will deliver. And the good, you know, Middle Earth, do you remember? Yes? The hobbits will help. But currently they're a little bit kind of sleepy and, you know, comatose. I think the members of pension funds, who are in fact the real end beneficiaries, the real owners, the pension funds are actually just another intermediary. You know, slightly less conflicted, slightly better remunerated for the long term. But it depends on the actual members, you, me, all of us, contacting our pension fund and asking about the things that we worry about. You know, if we're worried about pay, ask about that. If we're worried about preventable surprise risk coming from climate change, ask about that. You know, whatever it is that you're worried about, ask your pension fund, because they have a fiduciary obligation to look after your long-term interests. And
maybe also insurance companies.
Yes, insurance
maybe
companies.
Also endowment funds.
Absolutely.
Maybe even hedge funds.
Yeah, and if any of you happen to be high net worth individuals or know those people, ask them to ask them, because they have the biggest impact and quickest way to decision making. So I think that's one route. Another route, and actually I'm going to maybe challenge some of us in this room, is I think the public campaigning groups are actually going to push the agenda much faster than anyone else. For the last 15 years, mentioning the word inequality in the city and Wall Street was almost tantamount to getting yourself written off as a, you know, communist Al-Qaeda supporter. You know, some merging of all of those. Today, inequality is slap bang in the, on the agenda of the mainstream regulatory, corporate, investment community. You have funds that are actually looking into inequality as a way to buy and sell companies. So it's there. And who put it there? It was Occupy. You know, I have great hopes for the Archbishop of Canterbury, not only because he's a corporate economist, but knows about the community, but also because actually he has influence over one of the largest pools of assets in the UK, the Church Commissioners. And the Church Commissioners is already starting to be more proactive on remuneration and encouragingly so. So I think things are changing. You know, it's not quite the kind of Tunisian Arab Spring, yet, but I think things are moving, and you know, I don't want to put words in his mouth, but I think John Kay was writing in mind that we would get to another crisis, and at that point someone might be in place to do something about it. So, you know, maybe people are holding their powder dry till the times at which they're going to be taken seriously.
Thanks, Raj. Thank you.
Thank you.